welcome to Masterclass 11, which is Web3 fundraising for startups. This is a class that's being provided by STORM Partners on behalf of the Cardano community. We were funded by Catalyst Fund 11 to provide these classes. And really the goal is to allow entrepreneurs or people who are trying to catch the train while it's running to learn the fundamentals while they're continuing to do their normal activities, and to give people an overview on some core skills that they might need. If at any point during the lesson you have a question, please do let me know. I may not see the chat, but I'm happy to respond to questions. So how do you fund a startup the Web3 way? In the previous lessons, we talked about what makes a good startup, at least in the eyes of an investor, someone who is not passionate or invested in it, and it's not their baby. So what are the external indicators that show that a startup is going to succeed? And then in just the previous lesson, we talked about what are the traditional Web2 ways of raising funds, which can include things like angel investors and VCs and loans from banks and so on and so forth. This time, we're going to be focusing more on Web3 ways of raising money. And what we discovered while we were building this lesson plan is that there is so much to say on the topic that we had to split it into two things, into two separate lessons. So this is part one. We're going to talk about exciting stuff. It's really how to get cash the Web3 way. And we're going to start with a comparison of TradFi and DeFi. Again, if at any point you don't understand one of the terms I'm using, please let me know. TradFi means traditional finance. It's the old banking systems and traditional ways of raising money, whereas DeFi is decentralized finance. We'll talk about how DeFi applies to startup fundraising. We'll talk about ICOs, STOs, and IDOs, and we'll define those later, but those are initial coin offerings, security token offerings, and initial DEX offerings. We'll talk about how DEXs work, which are decentralized exchanges. And then maybe we'll start getting into the beginning of liquidity, but we won't really get into mining, yield farming, the kind of DeFi VCs quite yet, or kind of a very big complex view. Today, we're going to keep things very simple, and we'll end the lesson with what is a basic cycle of fundraising for most Web3 companies, including the token launch. So let's talk about the differences between TradFi and DeFi. Again, traditional finance on one side, decentralized finance on the other. And the difference is that in TradFi, the money is in the hands of large investors and funds. These are typically banks, they're typically VCs, and the types of investors who can afford to fund VCs. They might be large institutional funds as well, who are taking insurance money from retirees and dealing in the millions or billions of dollars. Had a great discussion the other day with a fund manager who was basically saying that anything under 20 million for a fund wasn't profitable because the administrative fees and the regulatory requirements and the need for staff would eat up the profits of running the fund. So they had done a $5 million fund for investment. And they basically, after getting experience, were able to run it as a break even for friends, but it wasn't how they made money. So these are big amounts of money. Fundraising requires months of going to events and meeting investors. I know some startup owners who, from the beginning of launching their startup all the way to the day they went bankrupt, did nothing but fundraising. It can be exhausting. It stops you from doing your main activity, which is ultimately building stuff and selling it. Or if you're an impact, going out and doing great things. So it can be a real drain on the resources of a founder. And usually the founder is the only person who can do the fundraising activity, unless you've already made money and you can hire a fundraiser. Because at an early stage, the best indication that your startup is going to succeed is actually the founder's initiative. Investors might choose to invest in TradFi based off complex personal systems. I was just reading this morning the 7 questions that a particular angel investor asks of founders. So everyone has their systems, they do their due diligence in different ways, and it can vary based off where in the process the startup might be. And it might also be personal preference, right? I know for a lot of early stage investors, it comes down to that personal interaction with the founder, or maybe believing that because of the investor's network or their own business activities, they might be able to help that startup to succeed. In TradFi, often subsequent rounds can dilute the existing shareholders. So imagine you have a VC coming into your startup as an investor. They might reduce the shares of the previous investors because the valuation has changed and they believe they should get a bigger amount. So that can mean that additional investors might not be a good thing for the existing investors. And there are usually few fixed pipelines and rules to being able to get funds, right? You have a few accelerators and incubators. You have a few ways to contact VCs. You have family offices and investors who want things pitched to them in a certain way. You have to make pitch decks. All these kind of unspoken rules can be a big drain on time and resources for founders. And then you have decentralized finance, which is the Web3 way of doing things, or the new way of doing things. And we'll talk about the principles of that. But basically, there are still large investors. So there are DeFi VCs and there are DeFi whales and big investors. But there are also retail investors, and there are, which means private investors, you and me and everyone else. And there are collectives, like we'll talk later about DAOs, which is a decentralized autonomous organization. But it makes investment in private equity or startups or ventures much more accessible to many people. And you don't necessarily have to restrict yourself to the opinion of a very small amount of people. Fundraising requires the building of a digital community, which isn't necessarily something that the founder has to do. You can have a community manager building that. You can have the founder inspiring and creating a vision for things, but then that can be followed up with either internal or external marketing resources. It can be much more casual. You don't have to necessarily show up in a suit to a pitch event. You can do an Ask Me Anything or an AMA and interact directly with your audience. You can participate in Discord chats or make videos on TikTok or socials. There's many more ways to interact with that audience of potential investors. And a lot of it is word of mouth, especially when you're dealing with private sales, which we'll talk about later. But there's a certain nature in DeFi and Web3 of people who know people inviting each other to invest in these early startups and getting good deals out of it. Investors might choose to invest based off personal systems, but they also might invest off tokenomics, which is basically a purpose of the project or the math behind the project. And it might also just be off marketing. When you look at fundraising around meme coins or things like that, it's really, does it emotionally strike the person? And since you can have many investors, there's reasons for that we'll get into. And therefore that the costs of investing can be much lower for each person. There's more opportunities for making kind of a gut feel decision and taking a limited risk, rather than having the 6-figure or 7-figure investments that require long due diligence and may end in disappointment for the raising team. The tokenomics of grant terms are set at the beginning and rarely changed. So actually, to change the rules of investment after the initial round can be seen as a little bit of a death blow for a project in Web3. It's not encouraged. Generally speaking, you set the structure of how you're going to raise funds at the beginning, and that structure stays throughout, and it's fair, right? So usually a subsequent investor will not be able to dilute the initial investors. Everyone gets the same rules. And there are also thousands of combinations by which we can use different elements of funding, and people can experiment with new ways of funding things, and different ways of doing it. So while in its essence, DeFi, decentralized finance, is a way of doing TradFi in a more software-oriented, decentralized way. It's cheaper. It has more people. It's different ways of doing it. There are also new models that are made possible because you've done a lot of things that Web3 makes possible. Now, what are those things? What is that kind of philosophical difference between DeFi and TradFi? One is security. The exchange of tokens for funding is usually governed by an auditable smart contract. You should do your own research, of course, but there is less opportunity to send funds blind to an account and have that money stolen for you, or having to go through a lawyer in escrow and having some sort of trust. I know even some investment opportunities have required people to travel and meet people face to face and shake their hands, to have this notion that things are real. But really, when things are decentralized, and we'll talk about different forms of fundraising, but in true decentralized finance, the contract and the math should all be visible to the participants, and that's where your trust, or your lack of requirement of trust, should come from. And it should also prevent scammers and hackers from being able to come in, which is usually why the security of a launch is audited. We talk about decentralization. So the access to funding is not dependent on the decision of one person, usually in decentralized finance. It might be run by a decentralized autonomous organization, or DAO, which is a community of people who have voting rights on something. Or it might be more of a crowdfunding model where people just own tokens and they make their own decisions individually, rather than having a group vote and then an all or nothing outcome. And those token holders might be very wealthy people who have lots of tokens, or they might be many small players who come together around a specific theme or idea that they want to participate in. DeFi is usually more scalable than typical TradFi processes. I want you to think of how in the traditional world an agreement is usually made, right? Especially in some countries, you might have to print a document. You're reviewing it line by line with your specific lawyer rather than the community coming together on a consensus. You might have to physically sign that document. That document needs to be then signed in multiple copies, maybe you and your counterparty and a witnessing attorney, or maybe you need a copy for the Register of Commerce that you then share. Those copies need to be stored somewhere. Someone needs to follow that. Whereas in DeFi, you just connect a wallet, put a token against something, and then you receive the digital version of that contract, and everything's recorded on the blockchain. It can be much more scalable to do in TradFi. You might have an easier time doing one transaction with a lot of money riding. But in DeFi, you can do the same amount of money in thousands of transactions or even hundreds of thousands of transactions at a relatively low cost. Especially since when you're dealing with very complex, large transactions in the traditional world, your notary, your lawyer, your banker, your M&A specialist might charge you a very large amount of money. Typically in DeFi, that is not going to be the case. And finally, there's ownership, right? When you're dealing with the traditional world, you might have moments where the shares that you've purchased are not yet in your hands, but the money has already been sent, or vice versa. You have sent the shares, but you haven't yet received the money. In good DeFi setups, you have a very short interval of time between when you put your assets in the hands of the system and you receive the value that you're supposed to receive. So across security, decentralization, scalability, and ownership, DeFi is usually superior to TradFi. How does DeFi apply specifically to fundraising? It means that by using those mechanisms and using those principles, a startup that has a good following can monetize their community. They can get cash from them. And this is kind of an evolution of the crowdfunding model in a certain way, except it doesn't depend on one particular site. Usually, it's more in the hands of the startup. But it is also harder sometimes to find a single large, what we call a silver bullet investor, which means that if I'm a very good startup and I have a very valuable idea and I'm willing to bring in an investor who's going to take part of my equity, I can maybe find one investor, at least one lead investor, who's going to be able to solve all my fundraising at once, which is the dream of most founders. And I will never have to fundraise again. Now, that's a perception. It's a little bit of a fallacy because you should always be preparing for the next fundraising round, whether it's DeFi or TradFi. But this does make that more rare to find a single investor. You're usually going to find people trying to spread their risks across many projects. There can be a dizzying array of options available in how to finance a business. I think there's some really cool stuff that you can do in DeFi. For example, you could do a private sale of tokens to get money for marketing, and then use that money to do a bigger sale, and then people could then loan out those tokens to get their value back and put that into another vehicle that would give them interest on it. So there's all kinds of very flexible things that can happen. It's very complex. It can make you a lot of money. It's also a good way to lose it. And there's also a different array of types of tokens that you can use. My main recommendation on this is, if you're interested in this, one, start learning the things that are most interesting to you, and ChatGPT is a great tool to try to figure out where you want to begin this process of learning. But when you get to a point when you want to do something, talk to people you trust who have already done it, and who are already familiar. And really, it's about having them tell you what you don't know yet, so you can learn the pitfalls before you put yourself at risk. There are also professionals in the space who can help you with these things. Again, it usually boils down to, you don't know what you don't know until you've either talked to someone or made your first mistakes. Just realize that if you're trying to solve a problem, there is probably a method for you to do that out there in the DeFi space that maybe doesn't exist in the traditional world. The cost of implementing a Web3 equivalent of a traditional financing strategy is often, but not always, less expensive. So the easiest thing is probably to tell you, when is it more expensive? It's more expensive when you're dealing with very, very large single transactions. So an example I always used to give is that for traditional banking, for example, if you want to send $100 from France to the US, or from Africa to South America, or anywhere else, usually the transaction fee is $25 from the sending bank and $25 from the receiving bank, so $50. So if you're sending $100, you lose half your value. But if you send $1 million, barring certain exceptions of due diligence and KYCs, that's a know your client. So it's when a bank investigates who the counterparties are and whether something is legal. You might still pay $25 from the sending bank and $25 from the receiving bank. So the fees on large transactions are very low. Whereas in Web3, depending on the way you're sending money, you might operate on a percentage, which means that a strict percentage, which means that your transaction fee on very small transactions, I'm talking like $1 or even a penny, might be extremely low, but the equivalent transaction fee on a large amount would be very high. So it's important when you're thinking about what am I trying to do? What am I trying to send? Looking at the terms and the details of that particular method and seeing what it's going to cost you. But most of the time, because you don't have as many intermediaries, as many banks, as many lawyers, as many notaries, it's going to be cheaper, or at least it should be. And if it's not, maybe there's a different way of doing what you're trying to do. There may be a personal preference by founders to use Web3 just because it gives you more freedom. It gives people less opportunities to tell you no. And we'll talk about how there are some DeFi ways of raising money that have no gatekeepers whatsoever, other than people's willingness to pay you. And it also might give you, again, because there's less centralization and because you might not have one big investor, you might not also have to be accountable to one particular investor. You would have to put out information to the group of investors or stakeholders. But there wouldn't be that direct control relationship, which is why founders might prefer Web3. The DeFi world can be a little bit more degen, which is a shortened form of degenerate, than the TradFi world. So when we say degen in Web3, what we usually mean is just going for the money at all costs, right? And that can mean that while if you were running a traditional brick or mortar process with traditional investors, they might give you time to develop your idea and reach profitability and slowly grow it. And maybe there would be a point where you were making enough money and that was fine. In DeFi, the trend is to fast profits, right? Because you can step in and you can step out of something. And that might mean that you gain value on your share price if you're doing a security token, or your token value very quickly, and you might lose that value very quickly also. So it's important to realize that that personal relationship that creates burdens and control on you might also, you lose the personal touch and the understanding of the investors sometimes, unless you have really good community management. And so the bottom line is that most startup founders have lived through the pain of continuously having to fundraise and maybe having to put the personal finances into something and finish an investing round, only have to start the next one. DeFi can give you more control over that process and more speed of execution, but it can also be very merciless when it comes to sinking a project if the community doesn't believe in it. So there are three main paths to initial funding, at least. There's an initial coin offering, and this is both what allowed Web3 to get started in terms of raising money, and it's also what gave Web3 a bad reputation. Imagine you were approached on the internet by someone, or maybe you met them at an event, and they said, hey, send your money to this address in an envelope, which is essentially what you're doing when you're sending tokens blind to someone else's wallet. And in return, I will give you a token, right, of value to be determined. Maybe it represents ownership or a revenue share of something, you don't know. And you're kind of trusting that person to do what they said. And a lot of people lost money in the initial phases of Web3 because there was no regulation, there were no contracts in place. It was all done on trust, and there were no systems really, right? It was all manual. And it wasn't all malicious, although there was a good bit of malice involved. Sometimes it was just young founders trying to do things and finding out they couldn't. A lot of manual processes that might go wrong. And so now an initial coin offering, which again is, I send money somewhere, someone sends me tokens in return. Maybe it makes sense, maybe it doesn't. It's considered more risky for both sellers and buyers for two reasons. One, because the buyer is at risk for scams. You send your money somewhere, you can't get it back, and you don't get what you were promised. But it's also risky for the issuer because regulators like the SEC and FINMA and AMF and others have taken a much stricter view on what you promise people and implied contract that exists between someone who is asking people for money to do an ICO and the people who are supposed to receive value in return. And so if you're not careful as someone who is just launching a token, you might find yourself personally liable or facing jail time or fines if you don't do this correctly. So it's really important when you're trying to do something like an ICO where you don't have that framework around you, that you know what you're doing, and that you're very clean in your approach, and maybe that you talk to a lawyer about it beforehand. It may be much safer to do it in some jurisdictions than other, but generally speaking, the more well-established projects are moving away from ICOs and more towards STOs and IDOs. An STO is a security token offering, and it doesn't have to be very complicated. Just remember that an STO is mirroring, using a digital product, your traditional share offering or equity offering that was done in traditional finance. It's just doing it faster, digitally, with more flexibility in terms of how you would do it, and less paperwork, less administrative fees, less bank involvement. There is usually still a contract in place, whether it's digital or physical, and there is still usually a regulatory aspect. In fact, in Switzerland, where Storm Partners is based, the regulation treats a security offering the same way it treats a private equity offering, right? There's no difference legally between an STO and the traditional ways of getting shares, except maybe in the costs of doing that. What happens after can be a little neat, in which you now have this digital share that can be transferred to people depending on what the rules between transferring the shares are. And it's a halfway step between the reliability of a traditional finance mechanism and the functionality, easiness, and flexibility of Web3. And then the really decentralized version of all this is called an initial DEX offering, or an IDO. Now a DEX is a decentralized exchange. So if you think of the New York Stock Exchange, if you think of the Commodities Market Exchange, these are all centralized exchanges. Someone is running them. There's a board, and everything is done by specific people. It probably has employees. Whereas a DEX is a decentralized version of that. It might be run by a cluster of individuals who have tokens to drive that access. Maybe they've delegated some functions to employees in exchange for money, but it doesn't necessarily have to run that way. Everything can be automated. And so it's an evolution of the ICO, where instead of trusting someone to send you something, there is a system or a contract that does it for you. They have better liquidity than ICOs, so you're not depending on one person's personal finances to make sure to grease the wheels of all these things coming. There are large pools of funds behind it, and we'll talk about that. But it does have less regulation than a security token offering, because typically the goal of a DEX, if it's decentralized, is that there's no one person that has power over it, and therefore there's no one person who is responsible for it. So it's much harder to prosecute the members of a DEX, as long as they're well established, than someone who's issuing an STO or operating a centralized exchange. And then often, instead of having a single person who's saying, yes, this is approved or not, you have decentralized review of projects and vetting, and you have smart contracts that reduce counterparty risk. Is the ICO still relevant? I think ICOs, and again, the difference between an ICO and a DEX is that an ICO is done manually, usually between two people or one person and several investors. ICOs still have their place, especially when it comes to the pre-launch stage, or what's called a private sale of tokens, between people who have an established relationship or reasons to trust each other. Or when there is a paper contract that's kind of binding the situation, and the use of tokens is really a way to make the transfer of ownership or voting rights or revenue share easier and more digital, but it is not the main reason why people are doing it that way. They're doing it on the basis of trust. Even in those situations, it's important to be aware of the regulatory specificities of where you are, and what the personal and company liability you might be exposed to by doing it that way, how it should be reported, and what you're allowed to do in terms of marketing it. So, for example, if other people by word of mouth talk about your project and people come to you and say, I would like to participate in your project. Can you tell me what it is? Can you give me the opportunity to participate in an ICO, a private sale, specifically ICO, or a private STO? That is very different in the eyes of the law from you going out and saying, do you want to participate in this? I think I can give you a good return, or God forbid that you say, you will make lots of money by buying my token, because that promise has regulatory implications that may not be good for you. And so to avoid the regulator stopping your process when you're right next to being able to raise money and start your business, or to have fines or personal liability, it's really better to talk to a lawyer first, talk to someone who's a specialist in token launches first, before you do an ICO that's not through a particular organization, so that you know you're protected. If you are launching a coin or a token that has a more of a utility value, so it's not about making money, it's about gaining access to services, or other benefits, business benefits, then there's less issue. But as soon as you start talking about value, about money, about returns on investment, then you need to be really careful about how you do it and what you talk about. If you want to know more about security token offerings, what I'd recommend is go to our YouTube channel at Decentral House, and check out the lesson that one of our lawyers did on the topic of security token offerings versus utility token offerings. It's a really good overview of what the differences are and what the requirements might be for each. And it's really going to, at least, again, let you know what you don't know so you can protect yourself. Um, Security token offerings can be more comfortable for large traditional investors. It's a small step to go from a physical contract to a digital contract, and from a digital contract to a token, as long as it does the same things and they're getting to operate and get the privileges and rights that they're used to. So again, that was, if you go to Decentral House on YouTube and you look at masterclass number 3, security tokens and utility tokens, we went over that in some depth. But now let's kind of deep dive into the IDO side of things, and let's talk about how a decentralized exchange works. So again, an exchange, when we think about it, is composed of a few things. It's a marketplace, right? So it's a means by which things can be bought and sold and listed and recorded. It's a liquidity pool. So when you think of a traditional exchange, the exchange members actually guarantee the trades of an exchange. I'm not sure if you knew that. But for example, the reason why the commodities market exchange, the CME, has not crashed is because the very few times that someone has not followed through on a deal, the members who receive fees for transactions and are rewarded have covered the deal itself. So there's a backup that allows that to function. And in a DEX, that's what's called a liquidity pool. Because it's decentralized, because there's no one person who's in charge of it usually, or else it wouldn't be a decentralized exchange, it would be a centralized exchange. There is usually some sort of governance mechanism that allows the community or the token holders to make choices about how a DEX will be run. And if you are excited about governance and about how things are managed, whether that's from a public sector like voting, or a private sector like boards of administration of companies, This can be very exciting. This idea that you could govern an organization through digital votes in an efficient way, right? So you have to be smart to set these things up. And then there are variables. So depending on the type of DeFi protocol, depending on the type of DEX, maybe those are interest rates, maybe those are transaction fees, maybe those are sizes of transactions, maybe there's different ways of calculating what the price should be. And all of those things are either set at the beginning and fixed, or they might change. We'll talk about pricing mechanisms, but they can also be governed by some sort of governance mechanism that might be votes or might be an algorithm. The marketplace, ultimately, when we think of a marketplace today, back in the day, it was people standing on a floor, waving tickets and shouting at each other and telling each other what's available and committing and then exchanging, and then everything would be tallied at the end of the day. When we talk about a marketplace in Web3, we usually mean some sort of digital interface, a user interface in which people can place orders. And those orders are backed by smart contracts, which means that they execute by themselves. There's no one taking the pieces of paper and checking them and comparing them and executing. It's all being done programmatically. And users can then buy and sell, or usually swap, right? So you usually swap different types of tokens for each other. In some sort of ultimately peer-to-peer transaction, but maybe that peer-to-peer transaction is going to go through the exchange or through a liquidity pool, which we'll go into more detail in a little bit. And participation may or may not include some sort of onboarding process where you tell the exchange or record some sort of information about yourself, or a know your client mechanism to make sure that you are a legal participant in this sort of activity, or that you're not someone who has been blacklisted because you've scammed people in the past. So it can all be part of that marketplace. Again, the liquidity pool is there to facilitate the trades between users. There's less risk of someone not fulfilling their obligation because, again, typically the trade is executed by a smart contract. So I put my side in, you put your side in, and it executes. But in order for that to happen when it's decentralized, and my account is not always connected to the system, and your account is not always connected to the system, we need a pool of available funds that enables those things to happen when we're not synchronized. And it also allows the exchange to operate 24/7, which is different from a traditional exchange or a bank that has opening hours and closing hours. And again, we'll dive into that in a little bit more detail. We talked about the governance mechanism, which is designed to help the DEX make non-programmatic decisions, or to set the values for a programmatic formula, while maintaining a sometimes philosophical or maybe contractual level of decentralization. I do know some organizations in the decentralized world that could be more decentralized, but who choose not to because the value and the faith of the community is based off this being decentralized, not having one person stepping in and making the decision. And that's often done through what's called a decentralized autonomous organization, which is a DAO, and we'll get into that in the next lesson. And then the variables, again, are the settings that define how a DEX might work. So imagine if we had a decentralized lemonade stand that someone was running. And looks like we have a question. Hold on one second. So what type, here's the question, I'm going to read it back. So what type of offering or platform would one use for crowdfunding of a technology build for a new platform? Or two, after tech implementation for crowdfunding of SME loans for up to 250K in other countries, e.g. Africa. And yep, good to see you, Ian. And the truth is, you could again, the challenge is that there's so many options of how to do it. I think your best bet, and and we could get into a lot of detail here. So your best bet is first to realize that typically in Web3, if something doesn't exist, the builders will usually just make it. And since there are close to, or maybe a little over now, 8 billion people on the planet, no, it was close to, I think it was 7.9 last time I checked. Someone has already built the thing that you're trying to get to. And so the key that you should do is figure out as specifically as possible what it is that you're trying to fund in terms of technology. So a technology build is still very broad. Is it blockchain? Is it a blockchain protocol? Is it hardware? Is it software? Is it a scalability solution that is built on top of a chain? Is it a decentralized app that's being built on top of a layer 2, which is itself built on several layer 1s? So you can get specific, and then you need to identify the community of interest that likes to invest in these things. And so one of the things that I'll recommend you if you're looking to fund things is take a look at a website that I'm putting in on the chat, which is called DeFi Llama. And you can think of DeFi Llama as the Crunchbase of Web3, where you can at any point see not just market information on tokens, but also what startups have been raising funds in Web3. And so that's a really good place to look. It'll be under raises, and there's a section for startups that have raised, and there's sections for investors who have raised. That's a really good place to look if you want to find out who is investing in the type of projects that you want to get funded. So, and again, this will be large investors, right? They're VCs or whales or other family offices or funders in the Web3 space who want to put hundreds of thousands or millions of dollars into a particular project because they believe that that is necessary. And it's updated fairly frequently. People submit their own funding rounds. And you can find who the lead investor was, but you can also find out who the follow investors were in case you already have a lead investor and you're trying to bring people together around a project. The other way is you can look at different decentralized exchanges, and you can launch a token on one of those exchanges who have a community that is interested in the things that you're doing. So for example, on Cardano, although Cardano is not itself a decentralized exchange, but the community is interested in topics around blockchain for good, as are others out there. So by starting and narrowing your field of looking for funding mechanisms within communities that are interested in your topic, you can typically find places where you will have a better chance of succeeding and have more traction and be able to build a better community and better following in those areas. When you're looking for crowdfunding of SME loans of up to 250K in other countries, for example, Africa, I would definitely go towards interest groups who are focused on Africa and the problem of finance in Africa. For example, I know that I spoke to the former finance minister of an African country who has made it their mission in life to close the leverage gap between the Western world and Africa. So in most cases in Africa, you can borrow 1-to-1 against your collateral. So if you have something worth $10,000, then you can borrow $10,000 against that capital. In the Western world, frequently you can borrow at 4 times leverage or 5 times leverage, right? So I can borrow against the value of a house as long as I only put 1/5 of the cost of that house down. And so there are very strong interest groups and development banks and others who want to close that gap, who want to provide that liquidity. And if you then use Web3 to make it possible for them to provide that kind of liquidity in a way that doesn't require them to trust you, right? The exchange is directly with the person taking the loan. The information is provided maybe from a local bank or maybe by a trusted party, and that's recorded on the blockchain. Then you can unlock that capital and make it easier for those pools of funds to contribute to the challenge of funding people in Africa. And I hope that answered your question. And again, if you want to go into more specifics, happy to do it. You know where I am. Getting back to the DEXs, we've talked about how DEXs work. Again, they're a decentralized exchange. There are vetting mechanisms by which you can list your token on it. Once you're listed, there are different mechanisms for pricing. So in practical terms, how does a DEX trade actually happen? You can see here that, let's say I have a token in my wallet. So for those of you who are really new to this, a wallet is a digital keyring that gives you access to tokens that represent value, right? And typically when you're dealing with the buy side of a DEX trade, especially if you're buying project tokens, the tokens that the buyer would have are called stable coins. They are either pegged or collateralized by fiat money or real money, if you will. So for example, you would place on the exchange from your wallet, you would have USDT or USDC, which is a tokenized form of a US dollar. So it's a crossover point between the traditional world and the Web3 world. And so I put my tokenized dollars here. I connect my wallet to the exchange, and I put my tokenized dollars into the smart contract, locking them in place. And the smart contract is just a piece of code that hopefully has been audited. And that smart contract is basically going to say, okay, now I have received this tokenized version of dollars. And the seller is going to put their tokenized version of whatever it is they're selling. It might be a different kind of token. It might be a token that represents a project or shares in a project, or it might be a different type of stablecoin. It could be anything. But they put their token on that side. I put my token on that side. And then based off a preset system of rules, those tokens get swapped. And so now in my wallet, I have the key to the other side of the deal. And in their wallet, they have the key to their side of the deal. And that allows them to own that other value that they wanted. And so in a peer-to-peer or a hybrid or an order book DEX, maybe the smart contract has two user wallets on two sides of it, and the things are swapping. But that's not always the case. In fact, it is usually much easier to have what's called a liquidity pool, because imagine if you had to be connected and lock your wallet in place for the entire time you were waiting for someone who wanted to sell the exact same thing you were buying on the other side, right? That wouldn't execute very quickly. So instead, what you have is you have a separate pool of people who have deposited both, in this case, the tokenized version of US dollars and the thing that my seller is selling. They've deposited both. And so, for example, I would put in my tokenized US dollar, and they would pull from the pool one of the tokens of the thing that I was wanting to buy. And then my tokenized dollar would go into the pool, and this token that I was buying would go into my wallet. Now, you understand that when that happens, the pool becomes unbalanced, right? When we started, we put the equivalent value in the two, and the pool becomes unbalanced. And that unbalance is dealt with by a price setting mechanism that basically says, now I have more tokenized US dollars and I have fewer of these blue tokens. So I, as the exchange, am going to make the blue tokens worth a little bit more and the US dollar tokens a little bit less. And therefore, someone will come along and sell me their blue token for a cheaper US dollar token and balance out the liquidity pool again. And so the bigger the liquidity pool, the bigger the buffer, and the more trades can be realized before you would potentially have a situation where no more trades could be executed. So that's why, for the service of allowing you to trade at any time, 24/7, the people who contribute funds to liquidity pools are usually given transaction fees in return. Now, these are going to be smaller transaction fees than a traditional system, but they still get some value. And then they trust the exchange to rebalance the pool in order to do that. And then the price or rate at which everything is traded is usually fixed by a pricing mechanism, which we'll go into next. So again, a quick note on liquidity. We talked about, since DEXs are decentralized, they don't take custody of your user's token. So I don't deposit my coin forever. I just connect my wallet for a moment, and then it executes. So they need liquidity pools to operate. And again, think about it, the liquidity pool provider is offering both sides of it, right? So they're putting in both the yellow and the blue tokens in, so that both sides of the transaction can be put in. There are various pricing mechanisms that can be put. The most common one is called an automated market maker, which we'll talk about in a moment. And then, as I said, liquidity providers are rewarded with transaction fees. Now, how is the price set? The price might be set by several ways. You might have outright pricing that might be fixed by the DAO or the issuer. That's not typical for a decentralized exchange, because if you have an outright price for something, then why go through the DEX at all? Why not just do it as an ICO? And the answer to that is usually that maybe the DEX offers additional services. Maybe they have a marketing package that you can buy at a relatively good cost. Maybe there's a community that always invests in that particular DEX, so you get more exposure. Maybe going through the vetting mechanism of the DEX, even though it's decentralized, has some sort of street cred associated with it. So you're on this DEX, you must be a good project. But again, outright pricing is going to be less common than some sort of system that's going to balance things out. It's also more frequent on systems where you're trading with one person directly. So you say you're willing to buy at a price, I'm willing to sell that at a price, and we execute the trade at that level. And all of the DEX then protects us with is making sure that the transaction occurs at the same time for both parties. An order board is kind of like the traditional stock exchange system, where maybe there are people who are willing to sell at a price, and there are people who are willing to buy at a lower price, and then the sellers are willing to buy at sell at a lower price, and the buyers are willing to buy at a higher price. And as soon as those prices line up, a trade is executed. So that's an order board. And the orders will be usually handled in the order they're received as soon as they can be matched. And finally, there's an automated market maker. So an automated market maker is stabilizing the pricing based off the liquidity pool. So there's the spread between the yellow tokens and the blue tokens is managed by this AMM, an automated market maker, along a formula that is designed to keep the ratio in the pool near constant. So as soon as I sell blue tokens, they become more expensive. And so people are willing to sell them to me. As soon as I sell yellow tokens, they become more expensive. So more people are willing to sell them to me, and everything balances out. There are people who are called arbitrageurs who make their money by finding these imbalances in various liquidity pools and finding ways to buy things cheap and sell them more expensive. So all of this is happening in a very complex, interconnected, and often algorithmically run way. If AMMs sound complicated, it's because they are. The math can be simple, and one of the most popular formulas of it is just X, the number of yellow tokens, times Y, the number of blue tokens, has to be equal to a constant, and that constant increases or decreases based off people putting liquidity in the pool. And while that at its base the math is simple, what it means is that if a very large trade goes through all at once, maybe you'll get a sudden shift in the balance of the pool. And that means that the value of these tokens might be lower, and the value of these tokens might be higher, but it won't be the total value. The total value that I would get as a liquidity pool provider will not be as high as if it was balanced. And we can go through the math separately if you want. Just ping me either on LinkedIn or separately. I can show you the numbers. But so basically, if you get an imbalance and you don't give people the time to arbitrage it back into balance, you can lose money. And that is called impermanent loss. It's pulling your funds from the liquidity pool during a time of imbalance. And so when you lock in your funds into a liquidity pool, you usually can pull them out at any time, but it is to your benefit to do it at a moment of low volatility, of stability in the pool, just like it is in your benefit to enter it at a moment of high volumes, of high volatility, because that's when you're getting the transaction fees that are making it worth it. And so to give you an idea, there are liquidity pools out there that will give you 10% return or higher, even 15, 20% return on the liquidity that you stake. But you also need to be prepared to have to leave it in there while things kind of stabilize out. Yeah, I think that's straightforward. So let's get to the pragmatic side. So we have DEXs out there. They are listing tokens, which can then be traded for other tokens, which may represent traditional money. How do I get listed by DEX? And the answer is, remember, we talked about how decentralization is a fundamental principle of DeFi and of Web3. And so there is no one way to get listed on a DEX. Each DEX has a different mechanism by which you might get listed. On Uniswap, which is an Ethereum-based DEX, which also uses AMM, by the way, in terms of its pricing mechanism, there is no vetting process. Anyone can be listed, from the scammiest of crappiest of most uninformed projects to the best. You can all be listed. The community reviews projects. They do it on social media, they do it on forums, they do it on review platforms, but they're all policing each other. So if you're going to buy on Uniswap, you should be really careful of researching what projects you're investing in, because there is a possibility, a non-insignificant possibility, that what you're paying for, what you're giving your token that has a value against another token, might not be worth anything. Or might not be perfectly secure in terms of being hacked. So that means that it's much more democratic, right? Anyone can participate, but it's also much more risky. On SushiSwap, which is a multi-chain DEX, so it operates on multiple blockchains, there is a launchpad service called Miso that helps new projects. And so you can apply to Miso to get accelerated and launched. Typically, they will have a marketing package. They might have a cost. Maybe they get paid in fiat. Maybe they get, so traditional money. Maybe they get paid in tokens. So let's say you are putting 1 million tokens on the market, and you have to give the launchpad 200,000 of those tokens, which they will then subsequently sell. But there's also a much more arduous vetting process, right? You have to get checked and make sure that you are a good project, that your smart contract has been audited, that you're not going to get hacked, that it's secure. And then the community also votes to allow new projects or not. So as a user, if I am going on SushiSwap and I'm buying something, I should still do my own research, but there is much less chance that a completely scammy project is just going to be there for me to buy, which is unlike a more open system. If I look at Polkadot, which you could consider to be a DEX for ecosystems, right? They're called they allow parachains to operate off it. So it's not a chain itself. It's not a DEX itself. It allows chains to run using their infrastructure, and they have auctions where the project or the project owner locks in a certain value for a period of time, or the community loans tokens to a project to lock it in for a period of time, and that allows them to participate on Polkadot. So remember, the bottom line of all this is that Web3 is decentralized. And so there is usually many ways to do the things that you want to do. It's just a question of, one, knowing what you want to do, knowing what you want to invest in, or know what you want to sell, and then looking into the different ways that that could be done, or even possibly building your own if it hasn't been done yet. And so a simple cycle of DeFi for fundraising in the most generic terms is a founder or a group of co-founders or a team builds a community. It always starts with community, right? You want people who are interested in your project, who are willing to invest in it, who maybe even would give you funds on a traditional crowdfunding platform, or maybe it's friends and family and they give you cash. And then you have to build a white paper. Now, a white paper is just basically a statement, which can be in plain English, but also in math, of how your token, how your smart contract, how your project is going to operate, what the token is for. Does it give you privileges if you're a token holder, or does it represent ownership or decision-making over the token or project? Does it give you revenue, a little bit like dividends? How is all that going to run, right? It's a description of how the thing works. So you need to write that. And then you need a smart contract that implements the white paper as much as possible without your interference, right? So it's not that the user is trusting you, it's that the smart contract delivers what the white paper promises, and that costs money, unless you yourself are a smart contract developer, in which case it takes time. There's some great agencies out there that will actually help you with the white paper, either in setting up the systems or in reviewing the legality of it. We do the legal side, although we do have some knowledge on the tokenomics as well. So it's always a good idea, if you're going to launch a project, to get that reviewed by someone who's done it before or has specialized knowledge. And then typically, so you gather initial funds. They might be your funds, they might be a community's funds. You build the initial version of whatever it is you're going to sell. And then typically that means that you're out of money at the first round. You conduct a private sale. So it's a mini ICO, initial coin offering, to people who have money and are willing to get the token in exchange for either cash or their support, right? So a launchpad might charge you tokens for their support in launching your project, or an investor might take tokens in exchange for cash, but they're going to want those tokens at a discount compared to when you're going to launch them. And then you use those to do the real marketing, right? So let's say if you built a community of 1,000 people to get the initial tiny bit of funds or the initial tiny bit of support, and you use that activity to write your white paper and your smart contract, you would use the money from the private sale to get 10,000 people or 100,000 people aligned around your project, so that you could really, really have a good crowd when you did your offering. You would choose a DEX. And again, each DEX has a different set of rules of how you can offer them, how it will get pricing. So you go through the vetting process, and then you would market your launch. And then all those parts of the community, whether they're big whales buying tens of thousands of tokens or they're small players buying a few, they would buy the token. You would receive the value in return, and you would use that to implement the project or startup that you plan to do, right? And maybe if you were running a decentralized lending program, that money would go into a pool and then would be used to fund different loan requesters and then the proceeds of that would go back into the pool. Maybe there are certain periods during which things can be traded or not traded. Maybe there's a buyback program where you might go in afterwards and repurchase things. Again, think about utility. So let's say that you're doing that loan program, right? If you had a utility function, maybe that gives people preference for receiving loans. Maybe it gives them a lower interest rate. Maybe it allows them to borrow more money because we know that they also have money in the pool, so they're borrowing their own money back. There's lots of things that can be done with these systems based off your white paper, based off your smart contract, based off the business you're going to build after you raise the funds. But that's the fundamentals of it. You build a community, you gather some initial funds, you launch on a DEX, you raise your real money, and then you go out and do something, whether that's something physical or digital. So hopefully that gave you a simple overview of how you can use Web3 to gather money for startups, and how that full cycle goes. If you have any questions, please do let me know. We are Storm Partners. We're a global team of experts and early adopters, and basically we are a consulting an advisory firm that provides services to people in the Web3 space, specifically focusing on ecosystem acceleration for groups like Cardano. And that's why we're doing this today. We were funded by the Cardano Catalyst funding mechanism. It's an innovation funding mechanism that was voted on by the community, similarly to what we just talked about in the DEX setting. And so they gave us funds to teach this course to their community and to other people who might be interested in the Cardano community, so that people can go onto Cardano and build really cool things. And again, remember, Cardano is particularly focused on the blockchain for good aspect and large enterprises. Does anybody have any questions, anything that I can talk through? Okay. You're welcome. Someone said thank you in the chat. If anyone has any other questions, we do have the whole series going on YouTube, again, under Decentral House. You're very welcome to watch it. You're very welcome to share those videos. Hey, Paul, good to see you. Paul Wang is another member of our community, and he does some really, really cool stuff with verifying the truthfulness of information or spotting disinformation, especially as it relates to investment. So really cool to see you here. And then always welcome to come visit us in Geneva at Decentral House. We're a community space for Web3 people. And if you're just stepping into Web3, remember this is a friendly community, especially in Cardano. They're very open. They'd love to tell you about how everything works. So don't hesitate to ask questions. We have all been at a point of confusion and lack of knowledge on Web3. It's massively complicated. It's growing every day, and it is no longer possible to know everything yourself. So you need to find those people in the community that you can trust and be your experts on the different topics that you're interested in. So thanks so much, and we'll go ahead and close it here.